Here we go. So, Rush, we can see you clearly. Can you hear us?
Yes, I can.
That's amazing. So give me a short minute to introduce you to the audience. We will now talk about the investment-focused China, and we are glad to have Rushabh Desai with us, the CEO of Allianz Real Estate Asia Pacific. Rush manages a portfolio of 9 billion there, and he held various positions before in GE Capital. Following the information that Allianz provides, Rush's mission is to grow the share of Asian investments in the entire portfolio of Allianz to 10% through direct investments, joint ventures, fund investments, and club deals. And following his analysis of the area, this region comprises of a balanced mix of mature economies as well as emerging markets. So, Rush, happy to have you, and looking forward to see your insights to China.
Thank you very much for the introduction, and thank you very much for having me the opportunity to speak at this forum. Unfortunately, I will have to speak in English. I am Rushabh Desai, as mentioned. I'm based in Singapore, working for Allianz Real Estate. It's 11:15 p.m. in Singapore, so I apologize. I can't be in office. I have to be home. But without further ado, I think today, I'll talk a little bit about Allianz Real Estate, which a lot of you are familiar with, but Allianz Real Estate is one of the largest global real estate investment managers with about 75 billion exposure to real estate. We have 3 lines of business. One is direct equity, where we buy 100% of an asset, or we do joint ventures with like-minded institutional investors, or we do a club transaction. We have indirect business line, which basically means we invest in other people's funds, and we have a fairly wide portfolio of about 14 billion euros investing in funds. And then we also do lending, as again, you must be aware, in predominantly in Europe and US. We don't do any lending in Asia. Our investments are span across 25 countries, so it's a well-diversified portfolios. We have about 20 offices globally, with about 500 people, including investment management, asset management, and all parts of an organization. We serve predominantly. We are a captive manager, investment manager for Allianz group of companies. Recently, we have also embarked upon an invest alongside Allianz strategy, whereby we bring in like-minded institutional investors to invest alongside Allianz, so that both Allianz as well as the third-party investor can benefit from the diversification. And to that effect, we have had a couple of early successes. We've raised a European lending fund, a debt fund in Europe. And we've also had a couple of joint ventures in Europe with some like-minded investors. And in Asia, we have launched a fund, core fund, and we are about to launch a second core fund in Asia Pacific. So in short, global real estate manager with a diversified portfolio, and most recently sort of creating further diversification for Allianz group of companies through invest alongside Allianz strategies. Before I get into China, a couple of words about Asia Pacific, and post the global financial crisis in about 2010, 2011, there was a pivot whereby Asia Pacific GDP, nominal GDP, became bigger than Europe and US, and that pivot was a very important pivot, where as the developed economies were recovering from the GFC, Asia Pacific was on a path of accelerated growth, and this was led by China, followed by India, though there was a big gap between China and India. And then, of course, there is the advanced economies of Japan, Australia, Singapore, Korea, which contribute to the Asia Pacific GDP. On a long-term basis, we are very positive about the future of Asia Pacific. The question always remains, how long is long? And we're all trying to find that answer. And we have to navigate through the challenges to be able to get to the long-term secular growth. But there's no doubt in our minds that on a long-term basis, Asia-Pacific is expected to dominate the global economy. Now, the one thing about Asia-Pacific, which may not be in the rest of the world, which we really like, is the diversity. And what I mean by that is, when you look at US and Europe, there's a lot of homogeneous markets. So kind of everything operates in the same fashion. Whereas in Asia Pacific, there is extreme amount of diversity, which can be very beneficial, especially in times of such pandemic, where every market or every economy operates very differently than the others, and they're not necessarily fully linked. For example, China is completely unlinked from India. Australia is completely unlinked from Japan. And so when there is a crisis in one of the markets, the other markets sort of still operates with full speed, and that allows you to have a resilient portfolio. And we've also seen that with the pandemic, where all the different Asian countries have come out of the pandemic at different points in time, and the vaccination rates have been different and they've opened differently. So the diversity within the Asia Pacific region is what is one of our thesis for investment for real estate in Asia. Now, talking about China, look, I think there are two ways to look at there are two ways to look at China. One is you sit outside of China, form a certain perception of China, good or bad, which creates a certain anxiety about what goes on in China. So that's sort of one way to look at China. The other way to look at China is to have boots on the ground, have people on the ground, have local experts in China who understand why China does things in a certain way, and irrespective of what the world thinks about it, and then tactically takes advantage of that understanding to selectively invest in China. And fortunately, we have been on the latter side, where we have got a team in China which tries to understand what goes on in China, and we have an Asia Pacific local team, and we try to make sense out of it and take advantage of that opportunity. But just simply China and numbers, and these are very staggering numbers, whichever way you look at it. 1.4 billion population. There's no other country with such a big amount of population. But the important thing is 1.2 billion of that population is middle class, and the middle class is rising in China. When you look at the Fortune Global 500 companies, about 140 companies are actually today in China. When you look at the e-commerce market, the size of that e-commerce market is 3 times the US e-commerce market. It's about $2 trillion. When you look at the real estate market in China, it's about $700 billion. So the numbers are very, very staggering, and it is almost impossible to be part of the global economy without taking part in some shape or form being connected or invested in Chinese companies or Chinese economy. Now, there are 3 important economic regions in China, which the government has been promoting. One is the Beijing Tianjin cluster, which is on the northeast side. Then there is the Yangtze River Delta cluster, which is sort of in the east, in the middle. The bottom, closer to Hong Kong, is the Greater Bay Area cluster. Now, all these 3 together form about 40 to 45% of the Chinese GDP. And these are the key areas of focus for any foreign investors coming into China. And that's where also the real estate investments thrive for the most part. Now, when we look at COVID-19, of course, we can discuss where did it start and how did it all come about. But the important thing is that China was first in and first out. China has been able to, use their policy of no COVID or zero COVID tolerance very effectively. And one imagines a size of 1.4 billion population. How do you contain COVID? But they have managed to do it, and they have very efficient infrastructure to be able to contain COVID. Whenever there is a COVID breakout, they test millions and millions of people immediately, and then isolate them and they track the movements of the people to make sure that they're containing COVID. And that's the path they have gone down upon. A lot of the other countries, rest of the world is looking at living with COVID, but China at this point is wants to have zero COVID tolerance, which is so far working well for them for the most part. It makes it difficult for foreigners to get into China because you have to do quarantine. But in general, life in China is very normal. Things are absolutely normal. People can walk without mask. There is business as usual, and everything is open. And that sort of has ensured that China gets back on the economic growth path faster than other economies. And China is not going to achieve the same type of growth rates that is achieved in the last decade of 10% plus, but I think it's going to be still mid to high single-digit GDP growth rates over the next couple of years, which relative to the rest of the world is very attractive in terms of the economy. Now, there are a few things we keep an eye on China, we have been seeing as a matter of policy. The first point is some of the mega trends, and I'll focus on three mega trends that really matter in China. The first one is dual circulation. Okay, they coined this term, which essentially means, if you think about China a decade ago, it was all about exports. They were focused on things outside of China, getting revenue from countries, non-Chinese or dominated regions, and they were very outwardly looking, and they prosper. There are a lot of prosperity due to that strategy, but in the last 2 to 3 years, they have switched into focusing on their domestic consumption because they didn't want to totally rely on other countries for their growth. And so what they're now focusing on is called the new economy in China, which focuses on domestic consumption, which focuses on self-sufficiency in terms of manufacturing as well as technology. And that new economy is having an increasing share of the GDP in China. It's currently at a 50-50 level, but the target is to get the new economy or domestic consumption drive over 2/3 of their GDP. So that's a switch that China is successfully making in terms of a policy. The other switch that is currently happening in China is urbanization. Now, for those who are familiar, China had restrictions on people moving within the country. So they have this system called Hoku system, which means that everybody needs to register in a particular region. And when you're moving from one region to another, you do have to get certain permits to be able to move. So that was very restrictive in the past, where people could not move from rural to the urban area. And again, the external world would think that is very controlling, but essentially that was done to ensure that agricultural or farmers don't move to the cities and give up on their farming. So they had tried to stop rural people to moving into urban areas. But now they're trying to relax that a little bit and encouraging more of an urbanization trend. And that is something as a policy we are keeping an eye on. And last but not the least, financial reforms. I think China has realized that it needs to embark on a financial reform and open up to the rest of the world. I don't think we are there yet in terms of fully opening up like the US or Europe, but I think some baby steps are being taken to ensure that the Chinese financial institutions are opening up to the rest of the world. Now, China obviously is a complicated place, and the geopolitics plays the center stage. I think the free trade and openness has been an issue in China. So if you're doing business in China, that is always going to be a concern. COVID-19 has also resulted in China plus one strategy, which is basically all the global firms do not want to rely on China as the only supply chain. So everybody's looking at an alternative supply chain. So what we like to call it from just in time to just in case. And this is driven by COVID-19. The Belt and Road Initiative, I think, is exerting China's influence, both economic and political, in a lot of the developing countries. And if you think about Pakistan, Afghanistan, that belt, China is exercising a lot of influence. If you think about Africa, also China is exercising a lot more influence than they were. So suddenly they have a lot more say in the global economy, and that cannot be ignored. The US-China tensions, I think, are here to stay, and they're not sort of going away. I think people have learned to live with it. And of course, Germany enjoys a very cordial relationship with China, thanks to Chancellor Merkel and President Xi. And I don't think that is going to change. And that, I think, is a positive for some of the European companies and German companies looking to invest in China. The latest round of policy measures, which I think you read a lot in the news, and there is a reason for everything you're reading, and I will talk about it, is the pursuit of common prosperity. I think on the last few years, China has sort of switched slightly towards capitalism, but now is getting sort of back to the balancing act and looking at common prosperity. And that agenda is on full force in China. Everything that you're reading in the newspaper, whether the Alibaba situation or the Evergrande situation, it's all linked to the need for common prosperity, which China is pushing very, very hard. And I will talk about it quickly. Basically, there are three things that has happened recently. One is the crackdown on tech firms, and everybody's worried outside of China. Why is China controlling the tech companies? Actually, it's nothing new. In Europe and US and other developed countries, there's anti-monopoly law. This is basically China's way of implementing anti-monopoly, where they're saying that the large tech firms like Alibaba and others, Tencent, cannot control the market. They want to able to incubate the smaller firms in the technology space and allow them to prosper, which they were not prospering. So China cracked down on the tech firms to ensure that there's no monopoly going on by some of these firms, which has become too big. There is the Evergrande situation, which all of us have read about. It's basically deleveraging. China had realized that the developers, especially the housing developers in China, were over leveraged, and they wanted them to be delevered. And they implemented a 3 red line policy, which measures your asset liability ratio, which looks at your debt equity ratio and the cash, long-term and short-term cash and your short-term debt ratios. So there are 3 red lines that they have created a policy. And anybody who breaches 2 red lines, which Evergrande did, the Chinese government takes action on it. It is a managed restructuring. In short, we don't have enough time to talk about the whole Evergrande situation, but in our opinion, it is a managed restructuring. It is a poster child of for the rest of the developers to ensure that they're deleveraging their balance sheet, and this largely impacts the condominium market. It doesn't have any impact on the commercial real estate that most of the foreign investors invest in. So it's a managed restructuring, but it's basically a deleveraging exercise for the real estate industry in China. And the last one that we are seeing now is the 3-child policy, which is coming back. And this is being driven by the fact that China's population is aging compared to India, which has a younger population. And it's also growing at a slower pace because they had a 1-child policy and a 2-child policy. And now they're reverting back to a 3-child policy to step up measures to ensure that people are having more kids and there's a younger population. And then to that effect, they've also done a ban on gaming, online gaming, private tutoring. Chinese and Asian parents are very focused on their children securing the best grades in school. It's almost an obsession, and in China, that's become an obsession. So the government has cracked down on this private tutoring where the parents spend a lot of money, and the middle class and the lower middle class cannot afford these things, to bring in a bit of a balance. And they have cracked down on all this tutoring and online gaming companies to bring in a bit of a balance in the society so that parents are willing to have more children and grow their family and not necessarily be burdened by some of the extra additional cost. So if you in short, if you think about these 3 topics that you've been reading in the newspaper, there is a reason to it, and all of the reasons are in with a positive change in mind. However, the way it's done sometimes, it seems to be a lot of it is forced than sort of going through a proper due policy process, which happens in some of the other countries. But if you spend time on it and understanding it, it's not necessarily a negative thing. In fact, it's a fairly positive thing if you are positioned in the right assets and the right sector in real estate. Now, talking about real estate, that's what I'm here to talk about. I think, office and logistics are the two key sectors of real estate that we look at in China. We try to stay away from most of the other sectors and are focusing on these because these don't get really impacted by any of the policies decisions. This is largely sort of left alone. Now, real estate, if you think about Shanghai and Beijing office cycle, Shanghai has had a lot of supply and now it's sort of correcting. It will take a couple of years to sort of absorb that supply, and it's going to come out of that cycle. Beijing, on the other hand, has had limited supply because Beijing is the capital of China, and it's not easy to get land there, and the supply has been very targeted towards IT parks and technology parks, which has flourished in the outskirts of Beijing. On the other hand, on logistics, logistics in China has seen exponential rental growth in the last decade. There were examples of 10, 20, 30% rental growth on an average every year in some of the regions and some of the assets. That has slowed down a little bit as the logistics market becomes bigger. That has slowed down, but the yields are still very attractive in the logistics space in China. Now, office, particularly what Allianz Real Estate likes, and we have invested in so far been successful, is we invest in offices which are linked to technology, or where the tenancy is linked to technology and innovation. So, for example, we have invested in business parks or IT parks, which we usually don't invest in other parts of the world except India and China, and it has been incredibly successful. We have stayed away from commercial real estate, the CBD, because there is a lot of supply in the decentralized area in Shanghai. And if you're focusing on those IT related or new economy related office buildings, it is flourishing fairly well. And if you think about the crackdown on Alibaba and Tencent and some of the big firms, it's actually helping us because our assets are actually comprising of tenants who are also small and medium enterprises or IT companies, which so far were not really able to grow because the Alibabas and Tencents of the world were growing very fast. And now with the crackdown on the bigger tech firms, the smaller companies are able to prosper and they have an opportunity to grow, which is helping us. In fact, we are losing tenants because we can't offer them expansion space. All the tenants are asking for more space in the same building, and we don't have any vacancy, and we actually sometimes have to lose tenants because we can't offer them more space in the building, which is a nice problem to have. But that's what we are seeing in some of our business parks and ID parks. On the other hand, if you have a CBD or a decentralized office building, there's a lot of supply and there is a challenge in terms of occupancy. But I think that should be taken care of in the next 2 to 3 years. So in short, in office, focus on technology tenants and drive that investment. Logistics is the other sector. We focus on the 3 main regions that I talked about earlier. Initially we were focused on a B2B, business to business tenants when the manufacturing was booming in China. We have shifted our strategy to focus on B2C, so business to consumer tenants. So a lot of 3PL companies. Especially in the times of COVID. The latest trend in China in e-commerce is called fastest to the market. So it's not anymore about just in time on inventory and everything else. It's about who can get to the market fast after receiving an order. So a lot of the things we are looking at, people are looking at fastest to the market. So you need to have a logistics facility which offers both assembling, so someone can manufacture something very quickly or assemble something like fabrics or clothes and immediately store it there and ship it to the market. So that's sort of the kind of the evolution of logistics in China. But the important thing there is that China never had a REIT market, and now China is opening up to REITs, starting with industrial, and the arbitrage between office cap rates and logistics cap rate was 200 basis points, and that is compressing. So logistics cap rates are compressing from 5% to 4.5%, which gives a lot of potential for making a lot of gains for institutional investors who own logistics in China. Last but not the least,
not to interrupt. However, if you would shorten to the last minute, because we do have the next guys in the pipeline, that would be amazing.
Sure. So look, multifamily in China is a growing sector, not institutionalized yet, but it's something that rental multifamily units will come up as urbanization happens. And my last slide is about structuring in China. I think some of you who have looked at China, there's a perception of cash trap. Cash trap is nothing but withholding tax. So your money actually doesn't get trapped unless you want to pay tax on it. So there is a way to structure it. There's an offshore and onshore structure which has been successfully implemented by all foreign institutional investors, and it works well to get our money out. We have about $2.5 billion of exposure to China, and we've never had an issue getting our money back from China. So from that perspective, I think it's, again, something that if one understands the detail, I think there is a way around of all the perceptions that are from sitting outside of China. With that, look, I think thanks for the opportunity, and this was a quick overview on how we see China in the real estate space.
Thanks a lot. I hope you hear it. I hope you hear the audience.
Thank you very much.
That's at least the best thing about these not only digital things, that you can hear people that have listened to you in person abroad, which is a good thing. So we have about 120 live people in the room, which are happy to have listened to you. So again, thanks a lot. There is no time for questions, unfortunately. I think I would have at least 20, at least to hear about Evergrande in detail, but we wouldn't touch this in. We have to do that and postpone that to another opportunity. Thanks a lot to Singapore. It's 11:30 there, and it's amazing that you took the time to join us. That's really appreciated. Thanks a lot.
No worries. Thank you very much.